Tom Halverson, thank you for being with us once again to talk about COVID-19 and the economy. We appreciate it. We want to return today to a subject that we broached a couple weeks ago, which is the impact of the pandemic on credit markets and financial institutions. We're starting to see now corporate bankruptcies occur, including a lot of high-profile names. There's a slide here that lists many of them that have been in the news over the past couple of weeks. Could you start by talking about corporate bankruptcies specifically and what you expect to see over the next several months?
Well, there's a historical, predictable pattern, right? You can go back and look at all the periods of recession since World War II. Every time there's a recession, there's a contraction of economic activity, which translates into a contraction in revenue and profitability in companies. And the top quartile people probably do pretty well. Bottom quartile people, not so much, right? So every time there's a recession, you see an increase in bond market defaults, increase in corporate bankruptcies. Given the magnitude of the COVID-19 economic contraction, which there's no equivalent to since the 1930s, and particularly that is highly concentrated in particular industry sectors as opposed to broadly distributed across the breadth and depth of the economy, you would expect to see more than even a normal expectation of bankruptcies to emerge as a consequence of this over the coming weeks and months.
We have a chart here from Bloomberg which shows large corporate bankruptcies, which is defined as companies with 50 million or more in liabilities. It's up, getting closer, higher than levels that we haven't seen since the last Great Recession. What do you expect going forward in terms of where this line is going to be headed?
Well, logically, given that this contraction is meaningfully larger than the contraction of 10 to 12 years ago, and particularly in certain sectors, I'd be very surprised if the number of large corporate bankruptcies doesn't exceed that which we experienced in the Great Recession. How much more it might exceed that by depends a lot on what the shape of the contraction curve is, right? Is the recovery an L or a U or a W or a V, which is a subject of great debate. But how much of a spike in corporate bankruptcies we have, well, will be a function of that, which is also a function of consumer behavior. Do people go back to purchasing in more normalized individual consumer behavior patterns, which would get us out of this contraction more quickly? That remains to be seen.
The reason we want to focus on this again is its impact on financial institutions and lenders and credit markets generally. In bankruptcy, the equity holders get wiped out. The creditors come in as the new owners of the assets of the company, and then they go from there. Just talk about the process and what it entails from the standpoint of a lender.
Well, it's a painful and difficult process for everybody who's involved, including for a lender. Lenders lend money expecting a certain outcome, which isn't to become equity owners of companies, right? But it does happen. It is a normal part and process of the capital allocation mechanism of which banks are a central part in a market economy. But it does force financial institutions to use muscles, much more heavily in a recession to sift and sort those companies that fall into the bankruptcy process, figure out how to work with a bankruptcy court to figure out whether they have a life after bankruptcy or not, and if they do, to help put together a capital structure that will allow a company emerging from bankruptcy to get back on its feet and be successful in the interests of its new owners and to its other broader group of stakeholders.
Last chart we have to show you shows the provisions for loan losses of the 5 largest U.S. banks by assets, both in the fourth quarter of 2019 and then in the first quarter of 2020. Just explain what this chart means for people who aren't bankers and then connect it to this corporate bankruptcy trend that we're seeing.
Well, they are very highly correlated. This is a very substantial increase in loan loss reserves. These decisions were taken by large, complicated, sophisticated financial institutions who looked forward into the future based on what they thought was going to occur as a result of COVID-19 and said to themselves, wow, we fully expect that there's going to be a lot more credit stress in the next few earnings periods. And as a result of that, we need to be setting aside more money, taking it out of current net income and putting it into loan loss reserves in expectations of those credit problems down the road. It is also, however, worth noting that there's another factor here, which is this was the first quarter that these institutions were subject to a new CECL regime with their regulator that changes the way they're supposed to methodologically calculate their loan loss reserves, which we think also increased the amount of loan loss reserves they wanted to carry in anticipation of those future things. And what that tells you is these large, sophisticated, complicated banks expect a lot more corporate bankruptcies, a lot more consumer bankruptcies, a lot more credit distress in general, and that they will have realized losses that come out of their loan loss reserves over the next few quarters.
So this chart, again, is only 5 banks. Is it safe to say this is something of a valid proxy for the entire banking industry in this country?
Yeah, I think it is, and exactly how correlated that is to any given bank is a function of what the portfolio allocation is of the assets on the balance sheet of that bank. Are you more consumer? Are you more corporate? Or have you got a lot of airlines and hospitality, or do you not? So everyone's going to be a little bit different based on geography and industry and concentrations and the like.
So I think the big question then, putting this all together, is how worried are you, or can we even know at this point whether there's going to be a real wave of credit stress that washes over the financial industry and causes real problems in the broader economy? Is that something you're worried about?
There's 2 parts to the answer. On the one hand, I think we can all expect a wave of credit stress and bankruptcies and so forth to wash over the economy, both at the consumer level and at the institutional level. It would be almost inconceivable to me for that not to be true. On the other hand, do I view that as a systemic risk to the health and well-being of the financial institutions or the banking sector or other parts of the financial institutions framework of the United States because they don't have enough capital and earnings to withstand it? No, I don't. Because one of the great things about how we entered COVID-19, our public finances are one thing, but the health and well-being of the financial services industry of the United States was stronger from a capital and earnings position entering the COVID-19 contraction than at any time in the history of the United States. So our financial institutions, and I would include the Farm Credit System in general, CoBank in particular, were stronger than they have ever been. They were capitalized and had earnings of what I would call the equivalent of prepared for a Category 5 hurricane, right? And we probably got a Category 5 hurricane, and I think we will withstand it. But we will have some broken windows, and we'll have water on the carpet, and the basement might get flooded, but the house will fundamentally be okay.
So if you are a corporate borrower and you're creditworthy, this is, I think, good news. Your bank will be there. You'll retain access to credit, et cetera.
I have been talking to many CEOs, including 2 today. And I tell our customers, I said, I know you have many things that you worry about in managing your business and worrying about how to position your business for future success in this difficult environment. But you shouldn't have to worry that one of your problems is the health and well-being of your bank if you're a customer of CoBank, or the banking system if you're just a corporate customer out there in the ether. Your problems are the problems the opportunities and challenges that you have in your business. If you are a credit-worthy borrower, then you should be able to get access to the capital that you need to run your business.